it's going to be step by step, small steps in Africa.
Okay, I understand that, until the situation doesn't improve, you won't be able to give a call. But you're saying that Africa is still a big drag and is still at 50% of its peak that we saw in FY22. Got it. Just a couple of final questions. The margins were very strong this time. You're back to 20% levels. Are there any more margin tailwinds, or do you think that it will be hard to hold on to 20% given that raw material costs are now starting to rise a bit?
See, it's very difficult to talk about the margins with any degree of finality, but because they are a blend of not just the product mix, but also of the country mix and the BU mix, as you know. Because there are 3-4 businesses out there and multiple countries, and each can have an impact. However, given the last quarter, and if we just sort of extrapolate on that basis, we are not seeing any major headwinds on commodities, etc. We are seeing, like I said, the domestic business, both three-wheelers and two-wheelers, going away. Chetak's contribution will increase. It might just pull back the margin tad. So the architecture is more or less in place. After that, it's a little bit of arithmetic, as to what mix, country mix and BU mix, how that changes. But individually, the architecture of the margin structure is very much to be expected to continue into the next quarter.
You can hold on to 20% margins by the end of this fiscal, right? Just trying to get at that.
Yeah, I mean, if no wheels come off,
Okay.
because of any sudden events, etc., we are not seeing any disturbing scenario in Q4.
All right, leave it at that. Thank you, Mr. Sharma, for joining in and speaking to us as always. We'll take a quick break on that note. That's the word coming in from Bajaj Auto. More on their interview later through the course of the day. But for now, Laurus Labs is a stock that's getting hit very hard. Satya Narayan Chava, the founder and CEO of the company, will join in to discuss their third quarter earnings. We also have Satya Narayan Raju, the MD and CEO at Canara Bank, to discuss their Q3 earnings as well. Stay tuned.
Welcome back. Let's get straight to the stock of the moment. That's Laurus Laboratories. Stock under big pressure as we speak. The street is clearly disappointing with the numbers that they have reported. More importantly will be, what's the outlook from here on? Mr. Chava, the founder and chief executive officer at the company, joins us on the show. Hi, sir. Good morning and good to see you in. Well, let's get straight to the point, right? You were guiding for the second half of the year being better than the first half. It doesn't appear the past quarter was very, very impressive. So give us a few details. What do you end with at this year, this fiscal year, that's FY24? And margins, you have been stating that they'll gradually recover. When do they recover to that 20% odd mark? And will Q4?
Thank you for the very important and pertinent question. As you see, the health business is determined by two things. One is the gross margin, and the second is quantum of the business. When you look at the last several quarters, our gross margin was well above 50%. If you look at last quarter, our gross margin was. That's the indication for the quality of the business. What we thought the volume of the business will pick up from Q3, there was a delay. We are committed to bring better results for the second half than the first half. We believe the worst is behind us, and the Q4 onwards, we should be able to deliver better results than what we delivered in the previous 3 quarters.
Okay,
Second,
all right, Mr.
There were many positives, and the only one negative is the quantum of the business didn't pick up. The positives were many. The number of RFPs we have submitted and we are winning projects in the CDMO space is very impressive. And second, the greenfield facility for animal health came online, and one product validation completed. As we speak, another product validation is going on. So that facility is coming on stream. And the second other point is the construction for large volume crop science chemicals is also starting. And we're about to integrate our R&D in the next few months. So except the quantum of the business, a lot of good things happening in the company right now.
Okay, you believe the worst is behind, so that's good news. But the street believed that in the past as well. Now tell us, for Q4, if you compare it with last year Q4, what kind of a growth can you deliver? Point number one. And point number two, what kind of a margin improvement are we looking at in Q4 and from there on, sir?
The Q3, we have delivered a gross margin of 54.4% with a EBITDA margin of a little over 15%. That's because of a lot of deleverage happening in the company, startup expenditure, increase in R&D expenditure, drag the EBITDA numbers. In the Q4, any improvement in sales over Q3, most of that gross margin will fall into EBITDA numbers. So EBITDA definitely will be about 20% in Q4. That's what we strongly believe. We were not giving a precise number, but it will be a percent EBITDA for the Q.
Mr. Chava, hi, good morning. Prashant here. You know, the thing which many are pointing out is that compared to the guidance, there has been, somewhat sort of consistent disappointment quarter after quarter. So that kind of raises the question, is something going wrong at a more level? So if you can address that briefly and just quantify what is the extent of deferment, delay that you see happen, and which impacted what you call the quantum of business.
That's only a few months delay in delivering our orders. And if you look at fundamentally, how you measure the success of any organization apart from the sales. We have gone through significant customer audits and also regulatory audits. All went very well. And the attrition level is very low. And we are filing new DMFs. And we are getting several new RFPs for our CDMO business. So those are the metrics which are very, very good for the organization. And nothing fundamentally wrong.
Okay. Mr. Chava, hi, good morning. I had some concerns about the balance sheet, so I wanted to address that. But before that, I heard you mention 20% margins. That is by when? By the end of 2025? Because 20% margins is a 500 basis points improvement compared to last quarter. I doubt that can take place, right?
No, Q4 will happen. Definitely.
20% margins by Q4?
Yeah, in Q4.
In Q4. Okay, got it. But on the debt side, your debt has risen by 500 crores quarter on quarter. There's some working pressure as well that you're facing. Your net debt to has moved up to 3 times. Just want to understand, should we expect more pressure on the balance sheet and any plans to retire debt?
In the coming few quarters, we don't have plans to retire debt because if you look at our capex number, what we invested in the last 3 years is close to 3,000 crores. Apart from capex, we also invested 400 crores in equity as well. So we invested 300 crores in Laurus Bio. We invested about little over 100 crores in ImmunoAct. We licensed patents from IIT Kanpur. So around 450 crore done in non-capex related items also. But these are all very necessary for us to diversify our business away from ARV business. As you have seen, there is not much growth in ARV business, both APS and formulations. The company has to sustain its future. So these diversification effects are putting some currently,
On
but
the okay.
future we are very, very confident.
But will there be more debt or taken on board? Just trying to understand that.
We have no intention to take additional debt. Because of low EBITDA, the numbers were debt by EBITDA was 3, but it will come down. We have no concerns.
All right, so debt has peaked out. Margins will improve from here on. What about the growth guidance, sir? Very quickly for FY25, what is the number you're looking at? I recall a year or so ago, you all were talking about $1 billion, which didn't happen. And that's what got the street. Is $1 billion anywhere close to that in FY25, sir? And margins of 20% will also?
I can give you margins will certainly improve beyond 20% in FY25. We are not giving any quantitative guidance on revenue. So only our numbers will speak in the coming quarters.
But what could the growth be like? You know, give and take everything. This year is going to be a weak year, FY20. So we let you go at that because we're focusing on margins of 20% by Q4 and we're holding you to that number. But growth on the base of FY24, what can it look like?
We have significant opportunities for growth, and we are not giving quantitative numbers, but good times are ahead of us. Yeah. No.
Okay. All right, Mr. Chava, we'll leave it there. And we hope to speak with you soon again at the end of the fourth quarter, 20%, at least in fourth quarter, and improvement in FY25 on top of that 20% number is what you're telling us. So nothing on the revenue at this point. So that's Laurus Laboratories come off. It started, I think, about 10% lower, but it's recovered about 4% from the day's lowest level. The market is not really giving you any clear signals one way or the other. It's selling off, it's recovering, but a middling kind of activity. 60 points lower is what we have on the Nifty. What else but PSUs, right, which is really top of the charts, blasting through. Railtel is up another 10%. It started about 3-4% higher. Shipping Corporation is up 10%. IIT is up 10%. And PTC is up 10%. So this is just a one-way move. MTNL, even some of these, stocks which basically completely off the radar. MTNL is one of them, is up 5%. So markets looking for ideas within this space because this is where most of the momentum is. And Neyveli Lignite, Chennai Petro. Maybe we can just pull up the Nifty PSE index and what that is doing after yesterday's strong showing. It's up about 1%, which makes it the top performing sector so far. By the way, the index itself, the Nifty PSE index this year is up 7%. So that kind of tells you the sharp outperformance we've seen. The Nifty is down 1.5% for the year. PSE index is up 7.5%. So sharp outperformance is what we have coming through. We'll have the Canara Bank management with us in just a bit from now. So just waiting for them to and we'll go across to them. But in the meanwhile, maybe look at KEI Industries. I pointed that out in the morning. It's down about 4%. Yesterday saw a sharp 10% rally, and that is seeing some amount of profit booking. SBI Life is down about 1.7. I think SBI Life reports numbers today. Stocks at about 1386, and you've got Premier Explosives, another one. It's got large volumes. It's down 8%. Premier Explosives, 1280 is what that is doing. Aarti Drugs is another one which is reported numbers. It's down about 4%. Actually, more often than not, at least so far in the earnings season, reactions have been to the downside. Both, the earnings surprise has been to the downside, and as consequently, stocks have also sold off. That's been the experience so far in the third quarter, guys.
Okay, yes. So, I just want to point out for Laurus Labs, right? By the way, it's not just a 6% fall in the stock, it is the volumes. Just look at the volumes. And I think at a time like this, when you're sitting with a lot of balance sheet pressure, he said that there is no plan to retire debt anytime soon. Laurus Labs is what I'm talking about. And debt has gone up for him. The debt to EBITDA is at 3 now compared to 1.5 times last year. So it's clearly the balance sheet pressure that the street is worried about. Of course, there are, issues with the overall business. But I think higher debt is something of a concern.
Absolutely. And of course, we'll see. The guidance may be a abridged version of the guidance with no revenue, etc. But they've got to stick to it now, is what they've put out. Well, the next management on our radar is Canara. A mixed set of third quarter earnings. There's a one-off in the net interest income. So we'll talk about that. Loan growth has come in. It's a decent growth. Although if you look at the last many quarters, it's at a 7-quarter low. We have Mr. K. Satyanarayana Raju, Managing Director and Chief Executive Officer at the bank with us. Mr. Raju, great to have you with us here. Good morning. Prashant this side. So let's just get that one-off in the interest income out of the way, sir. How much was that? Adjusted for that, what would NII be? What would net interest margins be, sir?
The next quarter also we are looking at the same, sir, whatever it is there, but some stress is there on the cost of deposits. That's because from January 1st onwards we are seeing a steep increase in the deposit rate of interest. So some stress is there, but still, as earlier we have given the guidance that our NIM will be 2.9 to 3. We are still continuing with that, and our efforts will continue to be nearer to the 3%.
NIM should be closer to 3%. Sorry, Mr. Raju, can you hear me, sir?
3%. Sir, I can hear you. Can you hear me?
I can hear you clearly. No, I was just asking you, there was a one-off in the interest income, right? How much was that? What was that?
No, that is actually, it is the one other income might be, you are speaking about the other interest income?
Income, yes.
1800, it has reflected there in that presentation. That is a regular, it is a interest on reverse repo, interest on swap rate of interest, interest on refunds, standing deposit facility, combination of several activities. Generally, you see that our LCR is 135%. So we have liquidity enough. Our retail term deposits are growing absolutely comfortable in the current financial year. Our absolute number 31,000 crores we grown in the retail term deposits. Almost 3-digit figure is accumulating in that retail term deposits. We have 6% excess SLR in our. That excess SLR window also we are using from borrowing from the RBI at a much cheaper rate compared to that domestic deposit rates. And we are also using, you know that our actually the priority sector is very comfortable for us. Our priority sector is before selling LC, it is around 56%. So we have an ample scope for claiming the refinance from NABARD as well as the SIDBI. All these avenues we are using effectively. When the liquidity problem is there in the market, we are using it in the overnight lending or a short-term lending and all those things. That is the reason, because the demand and supply, there is a huge demand for the liquidity, we are using that. Again, let me confirm to that, our NIM will be at 3%. Again, our NIM, what is the helpful for us is, our credit cost has come down to below 1%. I am sure that you might have observed that. That is also helping us in maintaining that NIM.
Okay. Mr. Hi, good morning. This is Sonia here. I just wanted to take a step back from the earnings and talk a little bit about the Canfin stake that Canara Bank has. What is the update on that? Any plans to sell stake in the near future?
No, still we believe that there is a scope to, the value will increase better, madam, in another 1 year period. So once that what we assumed it should be at least a minimum 4-digit figure, then we think of disinvestment in that. First we are working to make that the potential to take out of that. Whatever the potential available, we want to take that potential to the optimum level.
And has RBI instructed you to sell stake in Canfin? I mean, any kind of, a communication that you've received from the RBI to that effect? And what are we looking at in terms of a timeline?
No, madam, there is no such guidance from the regulator to reduce our stake in that.
Okay, there's nothing. Mr. Raju, forgive me to sort of go back and I'll just try and one more time. So there is a non-core other income which you've spoken about, but is there other income in the sort of interest in the NII, in income? And can you quantify that for us? Because I think in the call also you mentioned that that will not rise. Go on, sir.
Actually, that will not rise means the why we are told that it is actually interest what we are earning from the call money market or overnight lending and all. It's month to month depends on the liquidity position in the market. It's a demand and supply. But there is an increase for last 3 quarters on that. If the liquidity position is tight, we may do the same thing in the current quarter. it may not be a same scenario for the continuously for the every quarter. It's a purely demand and supply position.
Okay, all right. Hi, sir. Good morning. Nigel on this side. I've just looked at your employee cost. That's gone up by close to 750 crores on a quarterly basis. You know, there was that wage revision of around 17%, and I think that you had provided for 15%. Could you tell us what is the outlook on employee cost? If you could give us a quarterly number for quarter 4, and also for FY25, what will this employee cost look like?
Let me clarify to you that the employee bipartite settlement once in 5 years, it happens in the industry, and the current bipartite settlement is due from 1st November 2022. So up to December, it is a 14 months has been completed. In the first quarter, we were in the impression that it may grow at 10 to 12%, so we have provided 10%. Then next 3 quarters, we expected that it may go up to the 15%, we have provided at 15%. Now the industry bipartite settlement has been happened, and they have signed that pact, whatever it is their agreement between these two, and they have signed at 17%. So we have calculated for the last 14 months what is the exact requirement up to December 31st, 2023, and whatever the shortfall, that entire shortfall we have provided. In addition to that, monthly we are providing 115 crores per month as calculated based on the 15%. But now it is 17%. It is a cost will be every month will be 129 crores. So in addition to that 129 crores for 3 months, it is a 390 crores. We have provided 400 crores, 400 to 450 shortfall, whatever it is there for the last 14 months, that also has been added. In addition to that, because of this hike in this wage revision, there will be an actuaries impact also will be there. That impact we assessed around 400 to 450 crores. But we don't want to keep it at the fag end of the quarters while paying that money. That's why we have taken, since we are comfortable in our position, we have taken that to 250 crores out of that actuaries. So that also we have provided now itself.
Okay, just one final question on your loan growth, sir. Your loan growth is at a 7-quarter low. Just trying to understand that why is it that you're growing below the average of what, your industry or the peers are growing at? And what do you think the growth trajectory could be over the next couple of quarters?
So while giving that in the financial year itself, we have given you the guidance that our loan growth will be at 10.5, but we are expecting that we will grow at 12 to 14%. I interacted with you several times. I recall that the interactions. But during the last quarter, RBI has increased the risk weightages on certain exposures to NBFC and personal loans. When we have increased it has impacted our CRAR 52 basis points. So we want to pass on this burden to that for the NBFCs. 95% of we are the first banker to pass on that impact to the NBFCs. We have taken a corporate call that it has to be shared by both the parties. So we have negotiated with all the concerned NBFCs. 95 to 97% people have come forward and shared that burden. Only 1 or 2 cases where they are not their corporate call, as per that they are not inclined to increase it. So we have taken a call to let go approach. That's why we have taken the prepayment from them. That's why you see that our NBFC exposure, it has come down from quarter on quarter sequentially from 143 to 135, 1,35,000 crores. Otherwise, it's not that we are not growing below that. Our RAM credit, it is growing at 14.59, all-time high. This is the growth. And our guidance also, we have given that we want to inch towards the more RAM. And we want to maintain that around 60 to 40% between the RAM and the corporate.
Sir, thank you so much for answering all of our questions. Appreciate your time here on CNBC TV18. Well, Ceat is the other one. The stock is trading in the green. It was a decent set of earnings that the company reported. Improvement as well. Stock is actually trading in the red, I beg your pardon, down about 1.5%. We have Arnab Banerjee, the MD and CEO at Ceat, who joins us now to talk about that. Arnab, thanks a lot for joining in. I wanted to start by asking you about the volume growth this time. Volume growth is just about 7%. And given that there is a lot of competitive intensity in this space, do you think it will be hard for you to get to double-digit volume growth in FY24 itself? And what does FY25 look like in terms of volume growth? What are you forecasting? Arnab, I think you're on mute.
I'm sorry about that. So, Growth was very robust at about 12.5%, led by international business at 25%. Replacement volume growth was also very healthy, and OE was a tad lower. So we are looking at a similar kind of volume growth in Q4 as well.
What was the OE volume growth, Arnab?
OE was a tad lower. Replacement was very good. Exports was the highest at about 25% in Q3, YOY.
For FY25, I mean, as we look ahead, what should we expect in terms of volume growth overall?
FY25 is a bit far away. We are in the planning process right now. But given the OEM growth that we have witnessed in the last few years, if we translate it to replacement and our ambition in international, we would like to plan high single digit to double digit kind of volume growth for FY25.
And where do exports feature in that? Because I think in Q3, export volume growth was 10%. And you did mention, you know, in your release that the export markets are improving in Asia as well as in Africa, although Europe is still impacted by recessionary trends. So this 10% growth in exports is something that you think can continue even in Q4 and in the first half of FY25?
Yeah, I would like to correct the figure here. The Q3
Sure.
YY export volume growth was 25%. So we have grown robustly in export. Yes, there is headwind in Europe, especially for the agri radials and other categories of PCR, passenger. If you look at US, Latin America, and also, as you mentioned, Africa and Asia, overall growth is still robust. Order books are decent, so we would like to look at a very robust growth in future as well.
All right. There's been a big improvement in margins. You're sitting at 14% plus margins. But given that there's been a slight increase in raw material prices since the last quarter, do you think margins will peak out at these levels, or is there scope to improve further?
Actually, there's a slight drop Q on Q margin from 15 to 15.1. That has baked in the raw material increase because Q3 raw material vis-a-vis Q2 was about 2.5% higher. We don't expect Q4 to be very much different from Q3. So the raw material pressure will not be there in Q4. The sales are going to be higher. Typically, Q4 is better than Q3. Q3 is a lean quarter, typically. So yes, I think the margin should move in a narrow band, as we keep saying.
Sorry, Arnab, on the Europe point, which you briefly mentioned, other companies also that we've spoken with, and generally what you read is that that's the sector which is more important in terms of auto ancillaries, etc. Has some of that impact shown through in the quarter for which you've reported, or it'll show? Is there any impact at all, first of all, and will it show through? I'm talking about this disruption, the Red Sea disruption, etc. Or that is not an issue.
Yeah, it has an impact because the freight rates have gone up. So to that extent, there could be an impact on imported landed cost of raw material. On the international business side, Europe will be impacted, but Europe is already in a sort of recession. So the damage will be limited in that case. We don't see a major disruption so far. The impact is the freight rate.
All right. Thanks a lot for stopping by and speaking to CNBC TV18. Let's slip into a quick break. On the other side, we'll get our focus on the commodity markets. Manisha Gupta will join in for a roundup of all the action there. Stay tuned. Welcome back to Corporate Radar. Let's get going with the commodity markets now. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, I'm looking at the silver prices because one reason, the last couple of years, silver hasn't done so well. But this is even as markets have seen constant deficit here. But there are various reports coming in from major banks and brokerages suggesting that silver is the metal or commodity to watch out for now for 2024. Well, prices have declined 4.5% in the year in the last few years as well. Last year, as you can see, it was a flat year. Before that, a 3% gain. And for the last 3 years, it hasn't really performed. A huge 48% of gains. And this is the year when deficit also started to build up in the international markets. So 2019 and 20 were great years. And after that, it clearly has been consolidation to some profit taking. And I'll tell you on what we've done in sense of numbers in 2023 on a better size as well. So we started the year with $23.93 an ounce. And we closed the year at 23.76. So you can see the opening and closing really doesn't have too much of a difference there. It really is in the middle of it that you saw huge volatile moves come in for the silver prices. Below 20 at one point in time and then above 26 as well. So it has been a $7-8 of a big range that silver prices have seen in 2023. And the markets do believe that it's exactly the range that you could be looking at in this year as well, except that you will be looking at higher highs and higher lows as well. This is what we have in sense of demand and supply. And as you can see, the last 3 years have seen constant gains in sense of demand here. So from 1,000 million ounces to 1,100 to 1,235 is the expectation for this year. But vis-a-vis to that, the supply also seems to be increasing. Of course, last year was weaker and this was the biggest deficit, by the way, in a decade that we saw in sense of silver. And India imported record numbers of silver in 2022. We are sitting on a huge inventory right now and the demand is kind of stable and China demand seems to be picking up at this point in time. But what the street is looking for is the industrial demand. Once that starts picking up, especially from the photovoltaic industry, solar industry, that is when you will see the prices gain up as well. At this point in time, the weakness in US dollar, the bar and coin investment demand and the ETF demand are some of the supportive factors that the industry is looking at in sense of higher silver prices going forward. This is the trajectory or expectation for 2024. The HSBC report is the latest one to come in and they're anticipating $24 per ounce of a silver average price for this year. So slightly higher from where we are trading right now. But there are more bullish calls as well. TD Securities puts us at 26. 29 to 30 is what you have coming from Goldman Sachs, JP Morgan, Bank of America and Citi as well. So much higher from where we are trading right now, which is $23 an ounce. 30 of an average is where most of these banks believe that silver prices could surge to.
Manisha, thanks very much for that. We'll take a quick break here on the other side. Our special coverage on as far as countdown to the budget comes up. We get you excerpts from my colleague Lata's conversations with Ashish Gupta, Chief Investment Officer at Axis Mutual Fund, and Neelkanth Mishra, Chief Economist at Axis Bank. That's coming up in just a bit.
Hello and welcome to our budget countdown special. What the market expects from the budget is, of course, important. But on an ongoing basis, the market will be subject to cues from the global market, the global economy, as well as growth trends in the Indian economy and the corporate sector. The financial sector, including Reserve Bank's liquidity policy and the overall health of the financial sector, are also going to be key to forecasts about markets and macros. Today, I have with me two experts who cover practically all these gamuts. I have with me Neelkant Mishra, member of the Prime Minister's Economic Advisory Council, Chief Economist, Axis Bank, and Chief Equity Strategist at Axis Capital. In a bit, I'm also going to be joined by Ashish Gupta, the CIO, Fixed Income at Axis Mutual Fund, and the undoubted master of banking and finance. Welcome to the show. Neelkant, let me first start with you. I want to get to budget and what are the constraints and expectations. But before that, let's draw the global ambience. We are getting into a slightly stronger global economy than we had expected last year, you think? After all, US numbers are still looking strong.
Oh, I think it's exactly the opposite. So, in fact, what we are seeing now with the Chinese rate cut, I think the Chinese economy is actually struggling. I think the sentiment there consumer sentiment there seems to be particularly bad. They're trying all possible measures to support growth. In the US, where the growth surprise has been the strongest, in fact, everyone thought 2023 would be a recession year and it didn't happen. The reason for that is significantly higher fiscal spending. In fact, in the US, the fiscal deficit in the first 3 months of the year, which is October, November, December, is up by 20% year on year, nearly 1.3% of GDP. So when you have this level of expansion, you bound to see an economy which is not going into recession. So the question to ask is, when does this become unsustainable? Because so far, and it's actually quite scary, that nearly 80% of their incremental borrowing in FY23 was through T-bills, which is less than 1 year duration. As a stock of outstanding, notes and bonds are 75 to 80% of outstanding US debt, federal debt. But in the last 12 months, in the FY23, it was only about 19%. So the largest borrower in the world is borrowing very short. And they're doing it and they're getting away with it because all the surplus liquidity which was flowing out of deposits and into money market mutual funds was being sucked in by them. This cannot sustain forever. And I think this will mean higher inflation, supported growth, and also sustained higher interest rates globally.
Okay, so now what does this mean for India? I mean, let me relate it to the budget itself. Going by the example of the US, will our fiscal deficit be very closely watched and will we be under pressure to bring it down? You know, what's your number, really?
No, I think that the government has to stay committed to the consolidation path. So they have guided to getting from 5.9% to 4.5% by FY26. The only question then is, can they do 70 basis points in each year, or can they do 50 and then maybe do 80 or 90 later on? And we think that a 5.3, 5.4% will be the target. This is required to keep the foreign investors and the markets in general comfortable about India's macroeconomic stability.
Okay. But, 5.3 is what you're going with, you said.
Yes.
Okay. Now, if that happens, if even we had a kind of fiscal stimulus, so if that, is less than it was, then what repercussions can there be? Will the capex growth be not as good, or the capex stimulus that we got from the government not be as good as it was in FY23?
Let's divide it into two parts, right? So the first is that the level of fiscal deficit does not have a direct bearing on GDP growth. It is the change in fiscal deficit which has a bearing on GDP growth. So if you basis points, which is what we did in FY24, and I think we are likely to do better than that, you are actually already creating a headwind for GDP growth. So the 7% plus GDP growth we are seeing in FY24 is despite the fiscal consolidation that the government has undertaken.
Okay.
Now, if you see another 60 basis points, it's more or less the same as the reduction that we saw in the previous year. And therefore, I think incremental impact on the economy, because the economy seems to have a fairly strong momentum, and it should be able to withstand that. If the government was to attempt something even stronger than this, by saying that, no, we will consolidate by 1% point, then I would have expected that there could be a stronger growth headwind. Having said that, if we see that the global financial markets, and especially the US economy, gets into stormy waters, we may have to increase our fiscal support. And therefore, I think keeping some powder dry is also perhaps important. But this is a vote on account, so I don't think there will be too much nuance coming out in the budget.
Okay. Time permitting, I'll come back to this issue of fiscal deficit. But Ashish Gupta has joined us. Ashish, thank you, and sorry we started off without you. But you must have heard Neelkan speaking about the fiscal deficit at 5.3. For the bond markets, which you watch so closely, what is the number they'll be comfortable with? If that 5.3 turns out to be, say, 5.5, which some economists expect, then do you think it will be hell for the market, or it will take it in its stride?
I think 5.3, 5.4 is probably what the market is pricing in now. I think a marginal 0.1% swing either way is not really going to disrupt the market in a big way. The fact is that we also have to look at not just the demand side of it, but also supply, right? So what is going to be the appetite for bonds? And we have some appetite coming in because of the bond inclusion. I think the other big swing factor every year is going to be RBI's appetite. So what is the magnitude of OMOs RBI does? And if inflation continues to be under check, as has been noted in the last couple of months, I don't think there is any reason whether the projected fiscal deficit is 5.2 or 5.5, there should be any material negative reaction to the bond markets.
Okay. Would you very quickly agree with that, Neelkan, that, 5.5, if it were to come, will that be all that negative because there is a 25 billion appetite coming?
No, absolutely. And I agree with Ashish there that, look, if your borrowing is 11 lakh crores, I think 30,000 crores to make a song and dance about it is perhaps unwarranted.
Okay. Ashish, there are some tightness or more than just tightness that the Reserve Bank has introduced on unsecured loans, the higher risk weights on NBFCs, and its basic tight liquidity policy. How do you see all this? Is it already likely to slow credit? Your overall comment?
Yes. No, I think definitely there is this that if this kind of stance continues on liquidity, right, and on tightening of credit, and I'm not just referring to the fact that they're looking to tighten some segments, because in the overall context of things, I think that is macroprudential measure, some unsecured loan segment being tightened is actually more positive for longer term growth. My concern is if liquidity is kept too tight, if banks are constrained to lower their loan deposit ratios, I think we don't want to lose the overall credit momentum in the economy. Right, and my expectation would be that as we go through the year, while we have some consolidation on the fiscal side, being a bit of a drag on the economy, I think monetary conditions should actually become easier going into the year compared to at the start of the year, and that will counterbalance the fiscal pullback we have. But I think if and you would have seen the commentary from all the banks in the last few days, particularly the private banks that are looking to actually lower the loan deposit ratio. Really, the only lever they have is pull back on growth, because there's only so much you can do on the deposit side. Because at a systemic level, increasing rates on deposit does not necessarily mean there will be a meaningfully higher deposit growth, right? So I think we will need some more accommodative liquidity and credit stance to support this kind of real GDP growth.
I agree with you. And I'm going to come back to both of you on what you're expecting from the Reserve Bank and the Fed in terms of easier liquidity and financial conditions. But before that, since you have raised the topic of banks and they're looking for deposits, Neelkant, how do you assess this sudden stomping out of FIIs from the country? Is this all just disappointment with one bank's results or some banking results? Or is this got something to do with the SEBI rule on concentrated exposure? I mean, we were not prepared for like over $1 billion going out 2-3 days in a row at a time when the US is actually doing well.
Yeah, so see the anchoring here, see there are stock specific issues, right? So you rightly mentioned, I think there's disappointment with a few banks in terms of what perhaps was expected in terms of guidance and strategy and what the delivery has been. So there could be specific funds with specific holdings in particular banks which have sold off and have taken money out instead of redeploying that in other Indian stocks. But at a broader level and at a macro level, remember that a lot of the inflows that happened after what was seen as a very sharp Fed pivot in early December, where the 10-year bond yields in the US had fallen to 3.8%.
Yes.
The expectation was that now everything is, let's go back to the races. And that was the phase where liquidity, even for emerging markets and frontier markets, seemed to start easing.
Yeah, we went to 21,000 and then 22,000 around that time, yes.
Correct. So, and this was emerging market flows, right? So, the emerging markets saw significant rise in flows because, remember, if you're doing a contrarian trade in global financial markets, if you're doing a contrarian trade, then, short developed markets and long developing markets is the best possible trade, because for several years, the emerging markets have been completely bereft of fund flows. But when this happens, of course, there was a knee-jerk reaction that now the yields are falling and therefore let's go back to the races. But then you must have seen that the 10-year bond yields are up to 4.12.
That's right.
People have, even in the US, have started talking about what we have been talking about for the last 6 months, that the bond issuance is absolutely unsustainable. I mean, it will start pushing up yields. Expectations on rate cuts have been moderated. And so now, actually, emerging markets have been seeing outflows last 2 weeks. So while there are, I think, stock-specific issues with some of one of the major banks, I think there are bigger macro issues here as well, which is why the FII outflows are up.
Okay. Well, I have lots more questions on the budget, on the Reserve Bank, and on the banking sector. I have to take a break. Bazaar viewers will get to see this entire show after market hours. For you, it's Chartbusters time after a break.